This is Dwayne over at San Jose Options, and I put together a brief presentation here to answer a question that commonly comes up. And that question simply is, what are options? Well, the buyer of an option has the right, but not the obligation, to purchase a security at a set price within a defined time period. An option is a legal binding contract. Now that's the kind of answer you typically see when you start looking into options to try to figure out what they really are. And while informative, I think it still leaves things somewhat confusing. So let's discuss this concept in a completely different way. Let's imagine that you want to purchase a new car. Now, let's say you're looking at a car and you decide one that you're interested in buying, but you're not quite sure if you really want to do it, or perhaps you don't have enough money to buy it right now. So you approach the owner of the car and indicate your intention and desire to purchase this car, and would like to know if there's a way that you could have an agreement to buy the car at a set price within some time frame. So the owner comes back and says, yeah, for $1,000, you can have the option to buy this car within 3 months for the set price of $10,000. And so you say, okay, I agree to that. I'll take you up on it. So you pay him the $1,000, and now you own the contract, the right to buy this car within that 3-month time period at $10,000. Well, let's just say that shortly thereafter, the value of that car goes up to $20,000 because now it's a collector's item. There's something about it that has made it a collector's version of this car, and its value went up twofold. Well, you might think, I don't really want to buy such a expensive car, a high value car. I just need something I can drive around. So you have a choice here. You can still go ahead and buy that car for the $10,000 agreed to price and then turn around and sell the car. Or you could find somebody else who's interested in that car and sell them the contract, the option, the right to buy that car at $10,000. And in doing so, you would probably charge this person, maybe $5,000 or $6,000 for that contract. They still wind up ahead of the game because they can buy this expensive car now for only $10,000. You made out because you originally bought the contract for $1,000 and you're selling it for that agreed to $5,000 or $6,000 price. So you're happy with that, and you've turned over that particular contract. Now the opposite is true as well. Let's just say the price of this car all of a sudden plummets because it's determined that this car is unreliable and unsafe. Well, you had bought the option to purchase this car at $10,000, but maybe now it's only worth a couple thousand after all that bad press. Well, as I indicated earlier, you are not obligated to buy this car. You simply say, well, I no longer want to purchase this car. You let your contract expire. You're out the $1,000 that you spent for that contract, but you're not stuck with a car that's much, much less in value than you originally thought. So those are the basic premises and how these options work. So let's take it back to the stock market for a second. Here is a typical option chain. In this particular screen, while it looks very busy and complex, you'll see the same basic key points that I just talked to a moment ago in my auto purchasing scenario. We have the vehicle itself, and in this case our vehicle is going to be Apple Computer, shares within that company. You can see here that we have a time period specified. In this case it's July. But what you also notice is we have a variety, a chain of prices here that you're looking at considering purchasing those shares for. And then of course you have the asking price and what the current bidding price is for those particular contracts. So again, very similar to what I discussed in the other, I think more simple to visualize type of scenario, that of purchasing a car, versus what may seem somewhat daunting in the form of this complex option chain that you see for the stock market. So let me wrap up with just a few things that I want to leave you with. First off, one option contract controls 100 shares of stock. There is an expiration date associated with each contract. So not only are you watching the pricing of the various stocks that you're interested in, but also the anticipated time frames that are practical for the type of trade that you're considering. You can buy or sell the right, the option, to buy or sell the security. And again, that may sound a little bit confusing, but you have a lot of flexibility in how you put these options to work. Options can be used individually or combined to form more complex strategies. And my last point is that option trades are leveraged, so you need to be educated in the proper and safe use of option strategies. It's a very powerful tool, a very effective tool, but you need to make sure that you really are comfortable and knowledgeable in your application of those strategies in your investment style. So there you have it, a really brief and I think somewhat different outlook and overview of what these options really are. We cover a lot of different things here at San Jose Options, and glad to talk to you further. Thanks again.